Hey, what's up, my friend? So welcome, right, to the ultimate Forex trading course for beginners, right? So this is for you, right? If you're new to Forex trading, you have less than a year of experience, or you want to learn more about the Forex markets, then this course, right, will benefit you greatly. So let's begin. So first and foremost, what is Forex trading? Right, so Forex trading, right, or the word Forex refers to foreign exchange. What you're doing is trading one currency for another. So who trades Forex and why? So there are numerous market participants, right, who trade Forex. For example, you have the central banks, corporations, and retail traders. So central banks could be because, right, they want to make their economy more competitive, right, by devaluing their currency. Okay, so this makes their currency cheaper and exports will be more attractive. For banks, they could be because they are a market maker. They are making a market in the FX market, or perhaps they are trying to hedge their own portfolio. For corporations, right, it could be because they need to buy raw materials, so they need to, get involved in the foreign exchange. For example, if I'm Toyota, I need to buy raw materials for my tire. Maybe the tire is I'm buying from India. So what I'll do is that I will need to sell some Japanese yen, right, and buy Indian rupee, right, so that I can take this Indian rupee, right, and go to companies in India to exchange for the raw materials for my tires. An example. And for retail traders, it could be because, right, you are trading the forex market to speculate, to try, earn a profit, to, generate a better return compared to, putting your money in the bank, right? So these are the few groups of traders who trades the forex market. So as you can see over here, right, this is roughly how the forex market, the web, the network of the forex market looks like. So in the center, right, the one which does the bulk of this transaction are central banks and the major banks, right? Then you have the investment funds and corporations who are trading with the banks, and then finally, right, retail traders like you and me here, retail traders, right, who trades in the market as well. So this is the hierarchy, right? You can see that at the top of the food chain is the major banks, the central banks, then followed by medium-sized and smaller banks, then the brokers, okay, hedge funds, corporations, and finally retail traders at the bottom. So this is from Baby Pips, right? Advantages of forex trading. So there are numerous advantages of forex trading. Number one, there is high liquidity, right? So unlike stocks, that sometimes if you trade penny stocks or small cap stocks, right, there is no liquidity, right, and you have to pay a very wide bid-ask spread. But for forex trading, it typically have high liquidity, so this means that you can get in and out of the trade, right, relatively easy, right, without paying a huge premium or spread on it. There is low barrier to entry. Anyone can just open a forex trading account. Doesn't mean that you must be a high net worth individual and etc. Nope. Barrier to entry is low. Certain forex brokers allows you to trade nano lots. So this in return, right, allows you to better manage your risk. So for example, one of the big problems that I think most stock traders face is that, let's say you have small capital, let's say $500. And if you want to apply proper risk management on stocks, it can be difficult because let's say you want to risk 1% of your account. So $500 is like what, $5. If you pay the transaction cost, it's going to be more than $5, right, for stocks, right? You get your broker to do the transaction, right? I think like maybe one round trip is maybe already $10 or $20. So it's difficult to apply proper risk management on stocks, especially with small accounts. But for forex, it's possible because you can trade nano lots, right? And also forex, it doesn't have the what we call the traditional transaction cost. You only pay the spread, right? So this allows you to kind of like even risk $5 on a trade in forex if you are having the ability to trade nano lots with certain brokers. So it really helps you better manage your risk. You can trade anytime you want. Forex pretty much is the market is open 24/5 from Monday to Friday. So you wake up, the market is open. You sleep, the market is open. And yep, low transaction cost as I mentioned earlier. So just a quick recap, right? So forex trading, exchange of currencies, traded by banks, corporations, and retail traders, and these are the advantages that we covered earlier. So now, what are some of the different currency pairs in the market, right? There are three broad currency pairs that you should be aware of, right? The major currency pairs, crosses, and exotic currency pairs. So the major currency pairs, right, are typically currency pairs that are the most liquid, right? And they have a dollar element to it. For example, euro dollar, pound dollar, dollar Swiss, dollar yen, Aussie dollar, and Kiwi dollar, and dollar loonie. Notice that they all have the USD element in all of these currency pairs. And these 7 currency pairs are the most liquid currency pairs. So that's why they're called the major currency pairs, the most popular and most heavily traded currency pairs. And if you look at this, right, in 2016, right, the number one most actively traded currency pairs is USD, right, number one, followed by Euro, followed by Yen, Pound, Aussie, etc. So now let's talk about the cross-currency pairs. So cross-currency pairs are currency pairs that don't have a USD element to it. For example, Euro crosses, right, means that the currency pairs has a Euro element to it, right? Euro Swiss franc, Euro pound, Euro Aussie. The Yen crosses, right? Euro Yen, Pound Yen, Aussie Yen. Pound crosses, right, means that the currency pair have a pound element to it. Pound Aussie, Pound New Zealand, and Pound Canadian. What about exotic currency pairs? So these are usually currency pairs which are thinly traded. They have a wider bid-ask spread, okay? And the swings in this market can be more volatile as well. So some of these examples are dollar against the African rand, dollar against the Mexican peso, dollar against the Thai baht, dollar against the Indian rupee, dollar against the Turkish lira, okay? So moving on, right, let's talk about the different Forex trading sessions. So unlike the stock markets where you have just, one session, the Forex market, you have typically 3 different sessions: the Asian session, the London session, and the New York session. And they all open at different times of the day. Okay, and it's even worse, right, that these times of the day are not fixed because it really depends on where you are in the world. If you're in Asia, right, your time zone, right, the time is different compared to someone in New York. So I'm just going to go with a general example, right, and assume that you are from the US, right? So for the Asian session, right, it starts at 6 p.m. to 3 p.m. EDT, right? And this is during summer period from April to October. For the London session is from 3 p.m. to 12 a.m. EDT, and the New York session is 8 a.m. to 5 p.m. EDT. Now, what if you are not in US? Maybe you're in London, maybe you're in Singapore, Malaysia, right? How do you translate this to your own local time zone? Very simple. Just go down to Google and search for Forex trading session hours, right? So I'm sure there are a few results, right? The top few one that will tell you, right, what is the current Forex session in your time zone, in your local time zone. So just do a search, right? Forex trading hour session along that lines, right? Forex trading hours right now, Forex market hour session, something like that, right? And you will know what is the current Forex trading session in your time zone. And next, right, if during winter period around October to April, right, your Asian session starts at 6 p.m. to 3 p.m. EST, London is 3 p.m. to 12 a.m. EST, and New York is 8 a.m. to 5 p.m. EST. Okay? So, which is the best session to trade Forex? So, I think this kind of applies to almost any markets, right? The best times to trade is when there is volatility in the markets, because only when there is volatility, only when there is price movement can you make a profit. If the market don't move, you're not going to make a profit at all, right? You can't squeeze blood out of a rock. So you need to be trading when there is most volatility in the markets. And for day traders especially, right, the most volatile session is the London session. And to be precise, right, the most volatile period is actually the London and New York overlap session. So you can have a look at this. This is from Oenda. You can see that this is the start of the London session, end of London session. Start of New York session, end of New York session. So you can see that when London session starts, right, volatility has picked up. And historically, right, the market is most volatile during the London and New York overlap, as you can see over here. The volatility here is the highest during these 3 or 4 hours. Okay? Now, what about when is the best days to trade Forex? So the concept is still the same, right? You want to be trading Forex when the market tends to move, right, on a certain days, right? Which days does the Forex market tends to move the most? So Tuesday, Wednesday, Thursday generally is where the Forex market tends to move the most, right? If you look at this is from Baby Pips. You can see that this is the currency pair. This is the days of the week, right? And these are the movement of the movement of the currency pairs on average, right, on these different days of the week. So for example, Euro dollar on Tuesday, it tends to move around 142 pips. On Euro dollar on Wednesday, it tends to move about 136 pips. Thursday, it tends to move about, on average, 145 pips, right? So you can see that over here, right, if you look at it, right, Tuesday, Wednesday, Thursday tends to be when the FX markets move the most, right? So if you ask me, Tuesday, Wednesday, Thursday, those are the best days of the week to trade Forex. Now, moving on, right, let's talk about some common Forex trading terminologies, right? This might be slightly different from stocks, right? But generally, the concepts, right, can be applied the same, right? So we'll talk about what is long, what is short, what is leverage and margin, what is a pip, what is a bid and ask, and what is the spread. So what is long and short? So to put it simply, right, when you say that I'm long euro dollar, it means that, right, you're referring to the trade direction, right? You're bullish on euro dollar. You want euro dollar, right, to go up because that's where you'll make a profit. So if you are long, right, you want the market to go up so you can make a profit. If you're short, right, it means that you want the market to go down so you can make a profit. This means that you have a bearish bias, okay? So what is leverage and margin? So leverage refers, right, to how much more you can trade relative to your account size. So let's say, an example, right? Let's say you have a $10,000 trading account, right? $10,000 trading account, and you're using a leverage of, let's say, a 1 to 10 leverage, 1 to 10. This means, right, you can actually control 10 times more than your initial capital. This means your broker lets you trade up to $100,000 worth of currency, 10 times more than your initial capital. So this is what leverage means, right? How much more can you trade, right, relative to your initial trading capital? So margin is just another way of looking at it, right? If you just take 100 divided by leverage. So for example, earlier, the leverage is 10. So 100 divided by 10, it says that, your margin requirement, right, or rather the margin required, right, is just 10%, right? So if you want to trade $100,000 worth of currency, you only require to put up a 10% margin, which is $10,000. So it's just different ways of looking at it. One thing to point out is that leverage, right, it's a double-edged sword. You can make more in trading, but at the same time, you can also lose more. So let me share with you an example. So let's say, again, you have the $10,000 trading account, all right? And you're using a 1 to 10 leverage of 100K. We'll go with a stock example. Let's say we want to buy some shares of Apple, right? Say the shares of Apple is currently at $100. So let's say, shares of Apple has now moved up, right, to $110, 110. All right, so it's an increase of 10%. So if you're trading without leverage, right, you can see that you have actually made a gain of $1,000, 1K. If you're using leverage, you have made a gain of 10K. So if you put it into perspective, right, in percentage terms, right, what has happened is that without leverage, you have made a return of 10%. With leverage, you have made a return of 100% of your money. Okay, this might, looks good, right, and sounds really awesome, but I want you to take note, right, that what happens if the shares of Apple drops by 10%. Let's say right now from 100, it moved down to $90. So your capital with $10,000, right, is a drop of 10%. So you have lost 1K. If you're trading with leverage, right, 10 times leverage, right now, a drop of 10%, you have lost 10K. So pretty much essentially you have wiped out your entire trading account, right, when the shares of Apple has dropped 10%. So this is why I say that, leverage is a double-edged sword. You want to use this, right, with responsibility. You really must know what you're doing. So if you ask me, if you want to learn more about leverage on how to better position size your trade, right, this is more advanced stuff. You can go down to my website, tradingwithrainer.com/forex-risk-management. Right, that's where you can learn more about risk management and position sizing. So now moving on, right, what is a pip? A pip stands for point in percentage. It refers to the, for most currency pairs like the crosses, the major currency pairs, it's the 4th decimal place. So let's say, for example, euro dollar right now is trading at 1.2511. Okay, so let's say it moves up by 2 pips. So what this means, right, is that it has now moved up by 2 pips. Now the price is trading at 12513. Right, so you're looking at the 4th decimal place over here, right, for the most of the currency pairs. For the yen currency pairs, it's slightly different, right? So for yen, let's say it's trading at 120.10, right? Let's say it drops, right, 5 pips. So it's now trading at 120.05, right? You're looking at this 2nd decimal place over here for the yen currency pairs, right? So bear in mind, right? So pip basically refers to the smallest price move, right, in a currency pair. And one thing to note, right, sometimes, brokers, they just try to be funny, right? You can even have something called the pipette, right? So pipette right now, for most currency pairs is the 5th decimal place, right? And for this one over here is the 3rd decimal place. So you can really get you can really get really precise about it if you want to, right? So just something to share with you, right? It's called the pipette. So what is the bid and ask? All right, so this is the bid, right, refers to the price that you can sell at, and the ask is the price that you can buy at. So whenever you're trading Forex or whenever you're trading stocks, right, it's not just one price. It's always two prices, the bid and the ask. So let me share with you an example, right? Again, let's say for euro dollar, let's say it's trading at 12001 slash 1.2003. Okay? The higher value is always the ask, and the smaller value is always the bid. So if you look at this, right, and you refer to what I just mentioned earlier, the ask is the price you can buy at. So if you want a long euro dollar right now, you want to buy euro dollar, this is the price you have to pay, 1.2003. If you want to sell euro dollar right now, this is the price that you can sell, 1.2001. Okay, so this is what we mean by the bid and the ask, the price that you can buy and the price that you can sell at. And the difference between the ask and a bid is what we call the bid-ask spread, right? So if you look at this right now, if you take this one minus this one, you realize that it's 2 pips, right? So this, in other words, right, is the spread, the transaction cost that you have to pay to transact with your broker. So generally, right, for major currency pairs, the spread, right, it tends to be tighter, tends to be smaller. Whereas if you're trading exotic currency pairs, the spread over here tends to be bigger, wider. So in other words, you're paying more, right, to trade the exotic currency pairs. So what is the spread? Yep, as mentioned earlier, right, the difference between the bid and the ask. So now, how do you read a Forex chart, right? So let me share with you an example. Okay, so this is a Forex chart. So this one over here is from TradingView. You can go to tradingview.com over here, right, and get this access to free charts. Let's have a look at candlestick chart, right? So what you see over here right now is this red line over here is the price right now to trade New Zealand dollar. This is New Zealand dollar. Okay, so if you look at it, if you want to trade, right, let's say on sell, you notice that again there is two price, the bid and the ask. If you want to say, for example, do you see what I do? I click trade, sell New Zealand dollar, selling at the bid. That's what we mentioned earlier, right? You always sell at the bid price. Let's say right now I want to buy New Zealand dollar. You're buying at the ask. Okay, so as you can see right now, the bid ask spread on New Zealand dollars, you just take this one minus this one is 0.4 pips. Okay, so this is the bid ask spread. So in other words, right, let me just break it down to what it all means. So let's say you want to long New Zealand dollar right now, right? So you're long, this is the price that you have to pay. So what this means is that to buy 1 New Zealand dollar, all right, you have to pay 0.66017 US dollar, right? That is the cost to buy 1 New Zealand dollar right now. You have to pay 0.66017 US dollar. Okay, so that's pretty much how it works. So moving on, that's how you read a Forex chart, all right? Moving on, right? What is a Forex lot size? So lot size refers to how much of a Forex currency pair you can buy. All right, so there are different lot size. So the first one is what we call a standard lot, 100,000 units or currencies, right? Standard lot. Mini lot, 10,000 units. Micro lot, 1,000 units, and followed by nano lots, anything below 1,000 units. So nano lot is not offered by all brokers, right? Typically, brokers that are market maker, they tend to be able to offer nano lots, right? Otherwise, the most common Forex lot size that you'll trade is either the standard or the mini lot. So how do you calculate your gains and losses, right? So let me just walk you through an example. Let's say, earlier the New Zealand dollar example, let's say, let's make it euro dollar, right? That's the most common currency, 1.2001. Okay, let's say this is the price that you buy. You went long, L. And this is the price that you sold at, right? You sold at 1.2005. Okay? So, this is a price, call it S, right? Sell. This is long. So, what is your gain on this trade? Well, you can tell that you have actually earned 4 pips, right? You can tell, right? You earn 4 pips. Can't even spell it, right? You earn 4 pips, right? Because you take 1.2005 minus 1.2001. That's a difference of 4 pips. But how much do you make on this trade, right? Is dependent on your Forex lot size. Are you trading a standard lot? Are you trading a mini lot or micro lot? So a standard lot, right, is 100,000 units. Right? So generally, a standard lot 100,000 units, right? Each pip, right, is $10 per pip. Now, one thing to bear in mind is that depending on the currency that you're trading, depending on the currency that your account is funded, right, this figure over here will change over time. Okay, so you might need to check with your broker what is the value of 1 pip to you for one standard lot. So let's say, you are funded with a USD account and you're trading euro dollar. So it will be $10 per pip. So if you make 4 pips just now, you saw, right? You made 4 pips, right? Okay, let me I'm a little bit, okay, 4 pips. This is understandable. 4 pips, right? So what you'll do is you take 4 multiplied by 10. So that is a gain of $40 for you on that trade. Right? You take the number of pips that you have earned or lost, right? Multiply by this how many dollar per pip that you're trading, right? This value over here is dependent on your Forex lot size. If you're trading, so let's say 10,000 units, right? It will be $1 per pip, thereabout. Okay? So this is how you calculate your gains and loss in Forex. So moving on, right? The different types of Forex orders, right? So there are a few types, right? Market order, limit order, stop order, stop loss order. So let's talk about market order. So market order is an order, right, that tells your broker that, hey, I want to enter the market right now. I'm the boss. I want to enter right now. So the pros, right, of this approach is that you know for sure that you will be in the trade. The broker will, execute the trade for you at whatever is the market's prevailing price. The downside to this is that you're actually paying a premium. Sometimes the market is moving fast, it breaks out, it's going up. And if you hit a market order, you're paying a premium. Okay, so that is the pros and cons, right, of market order. Limit order, right, on the other hand, is you enter only if the market comes to your desired price level. Let's say, Apple shares, right, it's trading at $120. You think that, it's too high. I don't want to pay $120 for Apple shares. What you can do is use a buy limit order, all right, and put it at, let's say, $100. So this means that if Apple shares comes down to $100, only then will you get filled on the trade. So the pros of this approach is that you're typically, right, entering at a cheaper price, right? You let the market come to your price level. The downside of this approach is that you might miss the move because Apple might not come back to $100. It might go up to $150, $200, and hey, you missed the boat, man. And the other downside is that you're actually trading against the current momentum, because if you think about this, right, as the market fill you on the trade, you're actually trading against that down move against you, right? So that might be something that you want to be aware of as well. What about stop order, right? So a stop order is typically used, right, when you want to trade a breakout. When the market is moving in your favor, then you hop on and get on board the trade. So it's like, let's say Apple shares right now is $120, and you notice that this price, right, of Apple shares has not break above $130 over the last 2 years, right? So you want to trade the breakout on Apple because you might believe that, hey, if Apple hits $130, there's a good chance it could be at $140, $150 in a few weeks' time. So what you do is you can place a buy stop order on Apple shares at $130, right? So you only enter the trade if the price hits $130 and above. So this is what we call a buy stop order. The pros of this approach is that you're entering your trades, right, with momentum, because the market, right, the market has your back, right? Wind is at your back, right? So this is why you only enter when there is momentum in your favor. The downside to this is that this might be a false breakout, right? So what's a false breakout is actually, say the market, right, over here, it breaks out and then it does a reversal and goes back into the range. So this is what we call a false breakout. All right, so that might be possible, right, if you are using a stop order. And stop loss order, right, is pretty much an order, right, to exit your trade if it goes against you. It's somewhat like a insurance, right, to protect yourself, to protect your account if the trade goes against you. So let's say again, for example, Apple shares, you buy at $100. Okay, and you have a stop loss order at $90. So what this means, right, is that if the market, if the price comes to $90, you will exit the trade. All right, so this is what we mean by using a stop loss order. All right, so the beauty of this is that you're actually cutting your losses, you're limiting the damage that could be done to your trading account. The cons of this is that often, right, if you, I wouldn't say often, right, depending how you set your stop loss, right, but there's a very possible likelihood, right, that the market could hit your stop loss, right, and then reverse back in your initial direction. And then you might say, man, why did I use a stop loss? I'm so silly. Now I'm out of the trade and the market has went back in my favor. So yeah, you're going to get that quite a number of times in your trading journey, right? It's part and parcel of trading. So you want to embrace this fact, right? So this could jolly well happen. And if you think about this, this is worth it, right? Because what if the price doesn't go back into your intended direction? What if it drops to like $5, right? You have pretty much, wipe out a huge chunk of your capital. So stop loss order is like paying an insurance, right? It's like to give you a comfort of mind to know that you are protected no matter what happens, right? But sometimes, right, I would say that stop loss, right, is like paying insurance, right? It sucks, right, to pay insurance, but when the shit hits the fan, right, you're glad that you have your stop loss there to protect you, right? So that's the message that I want to bring across. Okay. So now, the different types of Forex chart, right? So generally there are many types of Forex chart, but I'm just going to share with you the three common ones: the line chart, bar chart, and the candlestick chart. So if you look at this one over here, right? Let's look at line chart first. Line chart, typically it's a line on your chart, right? So it only shows you, what it does is that it connects the closing prices of the chart. Okay, see, okay, you can choose it, right? Whether you want to choose the close, the open, high, whatever. But by default, it usually connects the closing prices on the chart, and it shows in the form as a line on this on the chart. It's very useful to identify the direction of the trend if you're not sure what is the trend. Okay, so that is a line chart. Moving on, right, we have what we call a bar chart. So a bar chart looks slightly different. Okay, so I'm just going to share with you how to interpret it. So let's talk about the green one you see over here. The green one typically means something like that, right? Goes up. Okay. Okay, so this is a green color bar chart. So what this means, right, is that the open price, right, or rather the closing price is above the open. So this is why it's bullish, right? The market has closed higher for the day. So this over here, this line that you see over here on the left is open. Okay, this one over here is the close. And this is the high of the day, and this is the low of the day. This is the low of the day. All right, so if you're looking at a daily time frame, this is what it means. If you're looking at a 1 hour time frame, then this is the high of the 1 hour time frame. This is the low over the last 1 hour. Okay, and if you're looking at weekly time frame, this is the high of the week, then this will be the low of the week. Okay, the low of the week. All right, so this is the again open, and this is the close. Now, what if you see a red color bar? What does it mean? Well, it's just the opposite actually. So getting the tools, okay. So if you see a red color bar, so what this means, right, is that again, right, if you are looking at the daily time frame, this is the high of the day, low of the day. This is the open, and this is the close. This should be quite common sense because this is a bearish bar because the price has closed lower for the day. All right, it has closed below the open. So the close has to be below the open. So the open is on top, the close is below, right? So this is how you read a bar chart. And for candlestick chart, okay, let's have a look, right? Same thing. The concept is the same. For green color bar, okay, let's say green color bar. This is the high of the day, the low of the day. Let's call it LH. So for it to be green, for it to be bullish, right, where must the open be? Well, the open must be below the close, right? So this over here is the open, and this over here is the close. Make sense? So now what about the red color bar that you see? So the red color bar is just the opposite. The red color bar like this, right here. So again, this is the high of the day, low of the day, H. No, this is the low, and this is the high. And where is the open? On the top or the bottom? Well, if you recall, right, for the bar to be bearish, right, the open has to be on top. Right, open. And this is the close. Price close lower for the day. Okay, does it make sense? Then let's move on. So now that you know how to read the different types of Forex chart, let's understand the different types of Forex analysis. Right? So you have fundamental analysis, you have technical analysis, and sentiment analysis. So what is fundamental analysis? So fundamental analysis typically deals with information like GDP, right, gross domestic product, interest rates, right, the non-farm payroll, consumer price index, right, the macroeconomic numbers, figures, right. These are all things to do with fundamental analysis. On the other hand, right, when you are dealing with technical analysis, you are using tools like support and resistance, candlestick patterns, Fibonacci ratios, and etc. Right, typically stuff that deals with charting, right, falls under technical analysis. And as for sentiment analysis, you're typically trying to gauge the sentiment of the markets. You're trying to identify what are the players doing. So what you can do is to use tools like the Commitment of Traders report. It tells you what are the commercial traders doing, what are the speculators doing, what are the what's the other one? Commercial speculators, and I think I can't remember what's the third category, right? So this is what the Commitment of Traders report would tell you, right? What are the different players of the market doing, and to give you a sentiment in the market. Then you also have the long short ratio, right? How many traders are long, how many are short, to kind of give you a sentiment to are traders bullish or bearish. So moving on, right? Let's talk about the different types of trading strategies, right? So there are many trading strategies out there, but generally it can be broken down into one of these three: position trading, swing trading, and day trading. So let's talk about position trading. So the idea, right, behind position trading is that you want to okay, let me just get the color right, is that you want to capture a trend in the market. So let's say, for example, the market is in an uptrend, okay, and then it comes down a bit. So as a position trader, what you are interested is to capture the meat of the trend, right? The meat of the trend, right? You can't possibly get in near the lows or the highs, but you're just focused on capturing the meat. So the meat of the trend, right? The bulk of it. So that is what a position trader tries to do. So you're typically trading on the 4-hour time frame and above, the 4-hour, daily, or even weekly time frame. And it's very suited, right, for those with a full-time job, because you don't need to monitor the markets all the time, right? You can just put on a trade, go to work, right? Settle your commitments and just come back before you sleep. Just check your charts once or twice per day. That's enough, right? Because position trading takes time to play out. Swing trading, on the other hand, right, it's usually between the 1 and 4-hour time frame, and it's for those with full-time jobs, but you want a little bit more action, right? Not so passive like a position trader. So swing trader, right, your goal over here is just to capture one swing in the market. So what is one swing? So this over here is one swing, this is one swing, this is another swing, and this is one swing. So as a swing trader, you're just interested in just capturing one swing in the market, and that's it. You're not interested in riding the entire move. So if let's say the market, right, it's in a trend, right, what you want to do as a swing trader is to buy near the lows of the pullback, and then as the market hits higher, just capture this one swing over here, and that's it. Okay, so day trading, right, is I would say a faster form of trading, right? It's really trading below the 1-hour time frame, and it's for those who want to trade for a living, right? Day trading, I would say it's quite hard for those of you who have full-time job, because day trading requires you to actively watch your trade, manage your positions, and if you have full-time commitment elsewhere, day trading is the last thing that you want to do. All right, so for day traders, right, typically you are just trading off the lower time frame and capturing the intraday's volatility. All right, so that's pretty much what day traders try to do. So now let's talk about the different types of Forex brokers, right? I think this is an important topic, and a topic that many of you are want to know more about, right? So for Forex brokers, generally it can be broken down into one of these two categories, right? A dealing desk broker and a non-dealing desk broker. Okay, so let's talk about dealing desk broker, right? So dealing desk broker, right, are pretty much brokers that are otherwise called market maker. Some of you might think, oh man, Rainer, market maker, right? So you have, like sort of bad blood against market maker because they hunt your stops, yada yada, right? But here's the thing, right? Market maker is nothing wrong. It's just the way their business model works, right? What they do is that for market maker, you're a trader, right? You would trade with the broker. Okay? So the broker would then, what they do is they will, if you're like, a consistently profitable trader, they would, usually try to match your trades with other traders that they have on hand, so they kind of net off their position, or pass your trades, right, to other liquidity providers. Okay, so they don't want to have anything to do with your trades. However, if they kind of see that, hey, you are, a trader that lose consistently, what they'll do is just to, trade against your position. Right? They won't purposely, hunt your stop loss and stuff like that, but they'll just trade against your position, take the opposite side of your position, because they know in the long run, right, you tend to lose over time. So that's the way, they handle their business operation, right? They won't go out of their way to purposely, stop you out of your trades. And the reason I say this is because the broking industry is highly competitive. If you're going to do this to your customers, right, it's going to be a matter of time, right, through social media, through reporting, right, before the word gets out, right, and you're going to have a bad reputation, and, you might even lose your entire business license altogether. So it's not worth, right, just to earn a few measly pips from a few traders to risk losing your entire business operation. Okay, but the fact is that they will take the opposite side of your trades if they look at your past record and realize that, hey, you are not a very profitable trader, you tend to lose over time, and to make things easier for them, they just take the opposite side of the trade, right, and, square it off. So on the other hand, right, you have what we call let's talk a little bit more about this, right? So basically, they are market maker, they take the opposite side of your trade, and it depends, right? Sometimes they can offer you a fixed spread. Sometimes the spread is not fixed, right? It's slightly variable, right? But more or less, right, over time, you'll tend to realize that the spread of your trades are pretty much fixed. And for market maker, they allow you to trade nano lots. So if a broker that allows you to trade smaller than 1,000 units, high chance, right, it's a market maker. Okay, and again, I repeat, right, there is nothing wrong or bad about market maker. It's just the way they run their business. It's their business model. So now, non-dealing desks, you have what we call ECN, Electronic Communication Network, and STP, Straight-Through Processing. So let's have a look, right? A non-dealing desk broker, right? So for example, this one is an ECN, right? What they'll do is that the trader, right, will trade with the broker, and the broker will just connect you directly to the interbank market, right? Means you can see the order flow of the other market participants for ECN. Okay, you can directly interact with other liquidity providers or other ECN participants, right? And usually you'll be charged a commission on your trade. So, for example, not only will you have to for ECN, right, you can actually queue at a bid and offer. So you may or may not have to pay the spread, right, if you get filled on the bid or the offer. Okay, but one thing for sure is that you will be charged a commission for every trade, right? Depending your broker how much he charge you, right? You will pay a fixed commission on it for this so-called service that the broker is offering you. So another type of a non-dealing desk is what we call a straight-through processing broker. What they do is, again, right, you're the trader, right? It's the broker. So the broker will get a quotes from all the different liquidity provider, right? And then share the most competitive one, right, with you, right? So what they'll do is that these are currently the bid and ask, right, by this liquidity provider A, B, and C. So what they'll do is they'll mark up this spread slightly, right, and then pass on the cost to you. So what they'll earn is the spread, right, the additional spread, right, from this quotes that they receive from the other liquidity providers. Okay, so this is how a straight-through processing broker works. So you can link you with other liquidity providers, right, and the spread is variable for this, right? So what they'll typically do is that they link you with the other liquidity providers, right? They would then help you find, the prevailing bid and ask spread, right? And then they bring back this piece of information to you, and then just add on mark up their own spread, right? And that's how they kind of earn it from you, right, for this service that they provide you with the other liquidity providers. So this is like kind of, one step behind the ECN that you see earlier. The ECN, you can go directly to the liquidity pool, put in your orders, and see the orders. For the STP, right, straight through processing, you can't see the orders directly, right? Only the brokers that you trade with can see the orders. Okay, so this area is a little bit gray over here. So who to choose, right, over here as your broker? Should you go with the ECN, STP, or market maker? So for dealing desk, right, or otherwise known as market maker, I recommend it for new traders because primarily, right, they allow you to trade nano lots. This means that you can trade less than 1,000 units and help you better manage your risk, right? So this is important for new traders because you don't want to, go in with a fixed minimum lot size, like one lot. And then if your account size is too small, you can't apply proper risk management, you might, end up losing a lot faster. So for new traders, I recommend going with a dealing desk. Also, if you're a swing or position trader, I would say a dealing desk isn't that bad after all, because as a swing and position trader, your stop loss, right, tends to be pretty wide, 200-300 pips, no problem. And for dealing desk, right, even though their spread might be slightly higher, if you calculate the spread, right, as a how do you call it? A spread as a function of your stop loss, right? The spread is usually like 1/100 of your stop loss. So it's very small as well. So if you're a swing or position trader, right, I don't see why you might not want to consider a dealing desk. So for non-dealing desk, I would recommend for traders who trade actively, right? You're always in and out the markets, right? So this is where you want to get the best competitive spread, right? So I recommend it for day traders or scalpers to go with the non-dealing desk. And this is usually for traders who are more experienced, definitely, and have a decent account size. If you have $1,000 or $2,000, it's not going to make sense to be going with a non-dealing desk, okay? So now, how do you select a Forex broker? So I want to share with you a few things, that you want to pay attention to. Right, number one, regulation, execution, customer service, ease of withdrawal. Right, so let's talk about this, right? So regulation, right? You want to make sure that your broker, right, is regulated and regulated in the right countries. If you ask me, right, if you tell me that, hey, this broker is regulated in Cyprus, I don't care, that it's regulated, because it's in Cyprus, I don't even feel safe. So if you want to, make sure that your broker is regulated, I would suggest, right, make sure it's regulated by reputable authorities like, MAS, Monetary Authority Singapore. I think they have the FCA and a few others, right, from UK, Australia as well. So those are regulatory bodies, right, that you have more confidence in, okay? Second thing to take note of is the execution, right? How are your trades being executed? Is it like pretty instantaneously, or is there like always a delay? You get a recode, your orders get rejected, right? So you want to pay attention to how the brokers execute your trade. Third thing is customer service. I think it's important, right, to have a live help desk when the market hours are open, right? You want to speak to someone like, maybe there's a big news release that's coming out. Maybe your position got stopped out, right? And you wonder why that happens, right? You want to speak to a customer service that offers live chat support. Not, send an email and wait 5 days for a reply, right? That is bad. And ease of withdrawal. You want to get your money, pretty quickly, right? I would say in this day and age, right, you should get it within 5 working days. Right now, there's telegraphic transfer and stuff like that. So ease of withdrawal, right, it should be quite easy nowadays. All right. So let's say, for example, you trade with your broker and you find that your broker did something unjust to you. How can you protect yourself, right? So here are a few things that you can do. Right, number one, record and screen capture everything, right? Every time you put on a trade, or for example, you get stopped out, right, for no rhyme or reason, right? Record the trade, the chart, right, and screen capture it. Okay, second thing you can do, right, it's so once you record and screen capture everything, right, before you go to step 2 and 3, right, you want to reach out to your broker first and ask, hey, why is this happening? Right? Sometimes it could be because there is a big news event that's coming out, right? So this is why the spread tend to widen, right? And it's not that a broker wants to purposely widen the spread to stop you out. Sometimes it's because there is lack of liquidity in the Forex market. Like before NFP, right, the spread tends to widen. So if your stop loss, right, is near the market where it's trading right now, there's a good chance it could get stopped out. So anyway, screenshot your charts and bring it up to your broker first and ask for an explanation. If you're happy with the explanation, right, and then trade in a way that it doesn't happen or makes it unlikely for it to happen to you again. However, if you're not happy with the explanation and you feel that they are doing something fishy behind the scenes, right, you can always bring up to social media. Okay, there are so many Forex trading groups out there. Share the post, right, and let others give you their opinion. If they feel that, hey, it's something fishy, something is wrong, right, that post will go viral, right, and the broker would get a bad rep from it. And the last thing the broker wants is, to have such a bad reputation to affect, future business. And finally, right, if you still, want to do something about it, right, bring up to the authorities, right? For example, if you're in Singapore, you can go to MAS and, hey, tell them, say, hey, this broker is, I suspect it's not being fair, right? You bring up to MAS. MAS will then, find the broker, right, and say that, hey, I received XYZ email from this person, right? What's going on, blah, blah, blah. So the broker will get scared because they might risk losing their license if, many traders, report of such cases. So you can also bring up to the authorities, right? And to have them look into the matter. So I would say these are a few things that you can do to protect yourself, right? When you are trying to trade with the right Forex broker. All right. Okay, so with that said, right, I have come to the end of this Forex trading course. I hope you got as much value out of it. And if you want to learn more, okay, you can go down to my website, tradingwithrainer.com at the top over here. Okay, tradingwithrainer.com, right? And over here, right, we will cover more in depth about different trading strategies and techniques, right? So what you've learned so far are just the basics, foundation of Forex trading. We have not covered, technical analysis at all or in depth, right? So what you can do is go down to my website, tradingwithrainer.com, and over here I've got 2 trading guides for you. All right, the first one is the ultimate trend following guide. We'll talk about how you can go about riding massive trends in the market, and the other one is the ultimate guide to price action trading, how you can better time your entries and exits in the Forex market. So go to my website, click this blue button, right, and I'll send it to your inbox for free. Okay, so with that said, I've come to the end of this video. I hope you have, enjoyed it. You learned something from it, right? And if any questions for me, leave it in the comment section below. And you think this video is good, hit the like button on this video and subscribe to my YouTube channel, right? I would really appreciate it. So with that said, I wish you good luck and good trading till next time.